For years, we watched charts, tracked open interest, and debated theories, believing one day the banking system's silver game would finally snap under impossible leverage. Today, speculation ends, because the numbers no longer whisper warnings, they scream confession, revealing a system stretched past its mathematical breaking point. While traders celebrated silver's explosive breakout, something darker unfolded quietly inside the plumbing of global finance, far from retail screens. Emergency liquidity surged through the system, exposing stress that healthy institutions never reveal unless survival itself is at stake. This was not routine year-end adjustment, but a desperate response triggered by violent price movement against massive, entrenched short positions. The overnight repo market, normally invisible, suddenly became the headline, acting as the emergency room for institutions hemorrhaging cash. Banks do not rush to this facility unless private funding has evaporated and peers no longer trust their balance sheets. When silver vaulted higher overnight, margin math turned brutal, transforming paper losses into immediate, unavoidable cash demands. Every dollar silver climbed multiplied losses across millions of ounces, collapsing risk models that once assumed endless control. Clearing systems do not negotiate narratives or optimism, they calculate exposure and demand payment instantly, without mercy. Faced with liquidation, banks scrambled for collateral, pawning their safest assets just to survive another trading day. This sudden liquidity demand signals not strength, but exhaustion, revealing how close the system sits to forced unwinding. For decades, paper supplies suppressed price through leverage, but leverage becomes lethal when volatility accelerates beyond containment. What once looked like controlled dominance now resembles a trap, tightening as physical scarcity collides with financial promises. The silver market has shifted from speculation to confrontation between real metal and synthetic supply. This moment marks the transition from quiet imbalance to visible stress that cannot be hidden by accounting language. Liquidity injections buy time, not solutions, delaying consequences while amplifying the forces driving silver higher. Each intervention exposes deeper fragility, confirming that suppression depends entirely on infinite confidence in cash. Confidence breaks when emergency tools activate, signaling to global players that the system is no longer in control. Today is not a spike, but the opening chapter of a structural repricing driven by scarcity, leverage failure, and forced intervention. To understand why this matters, you must understand leverage. Because leverage turns routine price moves into existential threats when markets move violently. Silver futures allow control of enormous metal volumes with minimal cash, creating an illusion of stability that collapses once volatility accelerates. Each futures contract represents thousands of ounces, magnifying every dollar move into cascading losses across balance sheets. For years, this leverage enabled banks to dominate price action by flooding markets with paper supply. That dominance relied on calm conditions, predictable flows, and the assumption that prices could always be forced lower. When price breaks violently higher, leverage flips from weapon to liability almost instantly. Risk models built for gradual movement fail catastrophically during gap moves and overnight repricing events. This is when unrealized losses become real, demanding immediate cash rather than patient accounting explanations. Clearinghouses do not care about long-term narratives. They care about exposure at this moment. Margin calls arrive automatically, generated by algorithms indifferent to reputation or political importance. Banks faced a simple choice: post cash immediately or face forced liquidation at any price. Forced liquidation would have driven silver violently higher, compounding losses exponentially. To avoid that outcome, institutions reached for emergency liquidity regardless of stigma. This behavior exposes how fragile paper dominance becomes once confidence evaporates. Leverage requires continuous trust, stable funding, and obedient markets. When any one of those fails, the entire structure destabilizes rapidly. Silver's sudden repricing removed the illusion of control banks relied upon for decades. What appeared to be orderly suppression was revealed as a balance sheet tightrope. Emergency funding delays collapse, but confirms that collapse is mathematically possible. From this point forward, silver price discovery is no longer theoretical, it is enforced by math. While leverage explains the spark, the fire spreads through delivery obligations that paper markets assume will never be fully tested. Futures contracts promise metal delivery, yet most participants rely on cash settlement to avoid confronting physical reality. This system functions only while confidence remains that few will ever demand actual silver bars. When price rises rapidly, incentives flip, and holders suddenly prefer metal over depreciating currency. Each delivery notice converts abstract exposure into a logistical obligation that cannot be printed or postponed. Vault inventories appear large on paper, but much of that silver is already encumbered by prior claims. Multiple owners often believe they control the same ounces, an illusion sustained by orderly markets. Delivery pressure collapses that illusion, forcing the market to reconcile promises with inventory. As notices accumulate, clearing members must source real metal or negotiate costly alternatives. Rising lease rates signal stress, revealing scarcity long before official reports acknowledge it. Borrowing silver becomes expensive when supply tightens and trust in availability erodes. This cost feeds back into price, amplifying upside pressure as shorts scramble for coverage. Physical demand transforms silver from a trading vehicle into a strategic asset. Industrial users quietly compete with investors, draining inventories needed for settlement. Unlike paper contracts, factories cannot substitute narratives for raw material. Every ounce delivered reduces remaining float, increasing tension across the entire system. At this stage, volatility is no longer speculative, it is structural. Attempts to suppress price accelerate depletion, worsening the very problem they aim to solve. Delivery stress exposes silver as finite, contradicting decades of paper abundance. Once physical reality dominates, price must adjust upward until demand destruction occurs. As delivery tightens, attention shifts to exchange-traded products that promise silver exposure without demanding physical handling. These vehicles appear convenient, but their structure depends on continuous access to underlying metal. When physical demand surges, that access becomes contested, fragile, and increasingly expensive. Authorized participants must source silver in real markets, not theoretical spreadsheets. Rising borrow fees quietly reveal stress before headlines ever acknowledge a shortage. When metal is easy to obtain, lending rates remain flat and unremarkable. When rates spike, it signals that inventory holders are reluctant to part with ounces. This reluctance reflects expectation of higher prices and distrust of counterparties. As costs rise, synthetic exposure becomes harder to maintain without impacting price. Funds must either pay escalating premiums or reduce exposure, tightening supply further. This feedback loop pushes silver upward through mechanisms invisible to casual observers. Retail investors see price movement, but professionals watch borrow rates and inventory flows. These indicators rarely move unless underlying conditions have already changed. Once exchange vehicles strain, confidence in paper substitutes erodes quickly. Investors then seek direct ownership, accelerating physical withdrawal from the system. Each redemption removes metal from circulation, increasing pressure on remaining supply. Attempts to cap price by expanding paper claims only worsen long-term imbalance. The market gradually learns that convenience carries hidden counterparty risk. Trust migrates from promises to possession as volatility intensifies. This transition marks another irreversible step toward true price discovery. As pressure builds in silver, attention inevitably turns to central banks tasked with preserving stability at any cost. These institutions monitor stress indicators long before public narratives adjust. Liquidity injections are not policy choices, but emergency reactions to cascading failure risk. When funding markets seize, central banks act to prevent systemic collapse. However, intervention cannot create physical metal where none exists. It can only paper over shortages by expanding balance sheets and delaying reckoning. Each rescue distorts signals, encouraging further speculation while weakening currency confidence. Investors recognize this pattern, responding by shifting capital toward tangible assets. Silver benefits uniquely because it straddles monetary history and industrial necessity. Central banks may suppress volatility temporarily, but they cannot eliminate scarcity. When interventions escalate, markets interpret them as confirmation of deeper structural problems. This interpretation fuels demand rather than calming it. The more aggressively authorities intervene, the more attractive silver becomes. Currency dilution amplifies metal prices as purchasing power erodes. This dynamic places policymakers in a dilemma with no painless exit. Tightening risks collapse, while easing accelerates asset inflation. Silver responds favorably to both outcomes, benefiting from instability itself. Historical cycles show metals outperform during prolonged monetary stress. What begins as crisis management evolves into long-term repricing. At this stage, silver no longer trades as a commodity, but as a signal of systemic trust. As silver reprices, global players reassess reserves, trade flows, and strategic stockpiles once considered irrelevant in a paper-dominated era. Nations understand that commodities underpin sovereignty when currencies weaken and supply chains fracture. Silver's role in energy, technology, and defense elevates it beyond simple investment demand. Governments quietly secure material access long before shortages reach public debate. Strategic buying tightens markets invisibly, amplifying stress already present in delivery systems. Unlike speculative demand, sovereign demand rarely retreats on price pullbacks. This creates a persistent bid that reshapes long-term market structure. Industrial consumption compounds the issue because substitution is limited and timelines are rigid. Manufacturing cannot pause indefinitely without cascading economic consequences. Every ounce diverted to strategic stockpiles reduces availability for commercial settlement. Global competition for silver mirrors broader competition for energy, food, and rare materials. Price signals emerge not from panic, but from sustained imbalance between need and supply. This imbalance rewards holders of physical metal with increasing leverage over markets. Control shifts gradually from financial intermediaries to those who possess inventory. Paper markets lose authority when delivery becomes the ultimate arbiter. Nations prepare quietly, because public acknowledgement would accelerate the very shortages they fear. Silver becomes insurance against geopolitical uncertainty and monetary disorder. These forces operate slowly, but their impact compounds relentlessly. What looks calm on screens masks intense competition behind closed doors. By the time headlines react, strategic repositioning is already complete. As silver tightens globally, market psychology shifts from trading opportunity to strategic urgency. Participants who once sold rallies now hesitate, recognizing that replacement risk has fundamentally changed. Replacement risk emerges when assets cannot be reacquired easily after being sold. In tight markets, sellers risk permanent exclusion from future supply. This fear alters behavior more powerfully than price charts or technical signals. Volatility increases not because of speculation, but because liquidity thins. Thin markets magnify every order, exposing how shallow paper depth truly is. Small buying waves generate outsized price responses under constrained conditions. Short sellers face asymmetric danger, where upside losses are unlimited and exit doors narrow. Each failed attempt to push price lower strengthens conviction among holders. This conviction hardens supply, reducing willingness to lend or sell. Liquidity becomes episodic, appearing briefly before vanishing again. Such behavior is typical in commodities transitioning from surplus to scarcity. Historical precedents show explosive repricing once hoarding replaces distribution. Silver begins behaving less like a traded metal and more like a reserve asset. Reserve assets move in steps, not smooth lines, shocking unprepared participants. Pullbacks become shallow. Violent rallies become frequent. This pattern frustrates traditional trading strategies built on mean reversion. Markets enter a regime change that invalidates prior assumptions. Those who recognize regime shifts early gain asymmetric advantage. Ultimately, silver's repricing is not a sudden event, but a process unfolding as assumptions fail one by one. Each failed assumption removes a layer of artificial supply that once restrained price. What remains is a smaller, tighter market governed by physical limits. Participants must adapt to a world where access matters more than leverage. Financial engineering loses effectiveness when confronted with finite resources. This shift forces capital to reevaluate risk, duration, and true ownership. Silver rewards patience because its supply responds slowly to rising prices. Mining timelines stretch years, not weeks, preventing rapid relief. Recycling helps marginally, but cannot offset structural deficits. Demand, however, responds immediately when confidence in currency weakens. This asymmetry drives powerful, sustained price trends. Volatility becomes a feature, not a flaw, of the repricing process. Attempts to time perfect entries grow less effective in trending scarcity markets. Long-term holders benefit from structural forces beyond short-term noise. The silver story is not about speculation, but about transition. Transition from paper dominance to physical accountability. Transition from abundance narratives to scarcity realities. Transition from complacency to strategic awareness. Those who understand this shift position themselves ahead of consensus. Silver's move ultimately reflects a broader reset in how value is measured.